I'm really excited to be hosting today's webinar that I'm sure will be providing some really interesting insights into, I'd say, one of the most polarizing, most talked about, and oftentimes very volatile financial assets that we see today, and that's Bitcoin, or BTC. In 2010, Bitcoin was merely a growing discourse amongst the fringes of technologists. It was worth literally $0 when the first official cryptocurrency exchange was launched. But today, over 18 million Bitcoin is in circulation with a total market cap of over 900 billion US dollars. Global investment banks have begun to offer crypto-related products to high net worth clients, and even more institutional investors have invested in the wider blockchain ecosystem. So I think it's fair to say that Bitcoin is fast becoming mainstream amongst investors who are willing to ride its market volatility to potential profit. And as more investors look to diversify their portfolios by investing into the most widely known cryptocurrencies, more questions around its risks, compliance, and market volatility abound. And that's why we've put together our panel discussion today, is to kind of walk through those topics. So I want to kick off the hour today by having one of our panelists, Adrian Chung, who is the founder and chairman of the Fundnel Group here in Singapore, share his views on investing in Bitcoin and cryptocurrencies, what the risks are, and how they can be mitigated with sound investment strategies. In conversation with Adrian, we're also happy to have Joel Xiao, who's a director at Morgan Lewis Stamford, join us in our panel discussion, where we'll discuss the case for and different methods to invest in Bitcoin, its risks, and how investors can mitigate the changes in regulations, price volatility, and cybersecurity concerns. So we'll also look into the future a little and get our panelists' insights into how the crypto investing landscape will continue to evolve. And with that, let me now pass the ball to Adrian, who will walk us through his presentation.
Great, thanks so much, Carlos, and great for us at Fundnel Group to have the opportunity to share our perspectives on Bitcoin and the cryptocurrency ecosystem. So I will just share the screen now and run through a few points about our views on Bitcoin and crypto. So, of course, there's a disclaimer, but what we're going to cover today is a few points. One is Fundnel's view that Bitcoin is becoming a fast-growing institutional asset class, and that's a big change from, as Carlos mentioned, when Bitcoin first started, and it's even a big change compared to, say, 3 or 4 years ago. We will also share that if it is an institutional asset class, then perhaps for a professional investor, it should be part of your portfolio. And we can share our views on perhaps what other people believe it should be in terms of percentage. However, the unique characteristics of Bitcoin and the cryptocurrency ecosystem is such that there are a number of risks and opportunities that investors should be aware of when you invest in Bitcoin. Very different to an established asset class like gold or equities. And then taking into account these risks and opportunities, we'll share a couple of ideas on how professional investors can invest in this asset class. So a little bit about Fundnel Group. We have been focused on fintech for the last 6-7 years. We really understand financial services and technology. We have a closed-end fintech fund where we've invested in a number of fintech companies, and we are, roughly 40-odd% IRR, 4 times X money. And I think in the next quarter we should be able to return the initial invested sum of the fund, and everything else will be upside. And it's actually through our fintech fund that we came across a number of different cryptocurrency companies. And back then, 2014, 15, 16, these really were Bitcoin related. Obviously now there's much broader range of cryptocurrencies. And it's through that experience and seeing the industry evolve really from 2 types of people we used to get involved in Bitcoin. As Carlos said, they were either technology geeks, technology specialists, or they were anarchists looking to bring down central banking and central governments. We fast forward to today, in the last 2 years, we really see a number of institutional professional players involved. And that's in line with how Bitcoin has become increasingly regulated. And with that experience, we also, and personal experience of investing in Bitcoin, we have created a couple of investment grade, institutional grade investment products. Because the nature of the asset class is there's not many regulated institutional grade products out there. So that's a little bit about Fintonia Group. Let's talk a little bit about Bitcoin. So for us, Bitcoin really is a form of digital gold. There are kind of three hypotheses about Bitcoin and as an asset class. One is that it is a store of value, like digital gold. A store of value essentially is perception, perceived value, and gold is perceived as a good store of value against inflation, for example. And in many ways, Bitcoin plays that role. The second role that people say Bitcoin plays is as a payment network, and finally as a unit of measure. Fintonia's view is that it is definitely a form of digital gold. We are not so sure it will be a payment network, but definitely as a form of gold. And what's important about Bitcoin is there are only 21 million Bitcoin, and most of it is already mined. What does that mean? That means actually you can price it. Supply is fixed, and therefore, as a measure against potential erosion of the dollar, as a measure against the current COVID stimulus that we see, Bitcoin is now seen as, hey, it can maintain its value. So I think that's one unique thing about Bitcoin. And you can compare that to gold, which is not so scarce, or obviously US dollar, which is being printed at record numbers. So Bitcoin, we think, as an institutional asset class, is the main cryptocurrency, is the only cryptocurrency that will perform the role of store of value or digital gold. It is the oldest cryptocurrency. It's been around for 12 years and the technology is proven. It has the widest network. And most importantly, it is the largest. It is roughly $990 billion market cap today. It's around 2 to 3 times larger than the second cryptocurrency, which would be Ether. It has daily liquidity of 40 to 60 billion per day. So really, we also have seen Q1 and Q2 flows of Bitcoin, 50 to 65% were institutional. And so what does that mean? It's really becoming an institutional asset class. It's here to stay, would be our view. And because it is so large and so liquid, it's kind of has the scale and network effects now. So it's unlikely to be overtaken by another cryptocurrency, at least in terms of store of value. There are other cryptocurrencies for other uses. And we see this in terms of where the big boys go. So Goldman Sachs now offers its clients, institutional clients, futures over Bitcoin. They call them NDFs, non-delivered forwards. JP Morgan banks Coinbase and Gemini. Morgan Stanley has applied to be able to offer derivatives to its clients. So when you see Wall Street moving in, they are just following in the money. Are they providing derivatives over Litecoin, Dogecoin, Cardano? No, they're offering these instruments on Bitcoin. So that has an ongoing network effect. So if we believe, and this is Fintonia's view, that Bitcoin really is fast becoming an institutional asset class, then it really should be part of your portfolio. If it is like gold, then we've just shared some other people's perspectives on what the value of Bitcoin is. We shared this earlier in August at 40,000. Now Bitcoin is 50,000. A number of people estimate that Bitcoin's value, if it is like a form of digital gold, a store of value, anywhere between 100,000 to 500,000. If it is actually a payment network, then there are some valuation numbers that are well over $1 million. But unlike gold, And this is why we see these kind of analysis that other people put up. Unlike gold, we're at the early stage of institutional adoption. So that's why there's $21 million, there's 21 million Bitcoin and it's fixed, and there is increased institutional interest. There really is only one way from a demand and supply that Bitcoin price can go. Over a period of time, obviously, we're not talking a day or a week, but over a period of time, if you say, hey, in the next 3 years, and institutional interest continues to increase as it has, then we know there's only 21 million. And then we know that what happens in terms of demand and supply. So how much should be part of your portfolio if you say that it's an institutional asset class? Well, various research has been done, which suggests that anywhere between 2.5% to 5% of your portfolio should be in Bitcoin. Now, what does that mean? There's essentially this measure called Sharpe ratio, or the return to volatility ratio. And it shows that this ratio improves if you were to add some of your assets into Bitcoin. Now, there are obviously other people who I would term the true believers, who would say, hey, this is too small. I have a number of friends that would say, put 10% of your portfolio in, because if Bitcoin goes up 10 times, then at least you've doubled your wealth. So put in 10%. I have friends that say, hey, put in 90% of their net worth into Bitcoin, and the rest in gold. And they've done very, very well, and they borrow money to do that. But for most people, as part of a portfolio, I guess Goldman's and other people suggesting 2.5% to 5%. Okay, so maybe Bitcoin should be part of your portfolio, you're thinking, but actually it has this great unique upside, but has some very unique risks that Carlos also mentioned. I think one important risk is security. If you are in, Bitcoin is where there's the internet, there's Bitcoin, right? So Bitcoin is connected to the internet. If you're connected to the internet, you can be hacked. And that's the reality. I was formerly, I've been a CEO of a couple of tech companies. One was jobsdb.com. We had 15 to 20 million, users a month. And every day, multiple times a day, we would have attempted hackings. And this is what we would know. I'm sure there are many that we wouldn't know. And that's just a job portal. We had job ads. If you're on an exchange and you're connected to the internet and you hold Bitcoin, and you must be connected to the internet to be able to trade, there is always a risk that you may be hacked. And we can see from the largest Mt. Gox, which had a 70% market share in 2014, 31 billion was hacked, right? And if you now look at Binance, which is now the largest, 2 years ago, 280 million. Last week, a very good exchange called Liquid in Japan, regulated in Japan, was hacked, 90 million. And then there was news articles last week from users in the US of Coinbase saying that their accounts got hacked and they can't get any response from Coinbase. And Coinbase hasn't said anything officially yet. So this is not to say exchanges are bad, but I think we need to realize that when you're connected to the internet, there are risks. And this is a major issue. Closer to home in Singapore, a company called Talk, earlier this year, investors, whether an exchange or a fund manager is not quite clear, but $400 million of cryptocurrency has gone. So security is a major risk, and you need to be aware of that and how to manage that. What about the regulator? Well, actually, our view is the more Bitcoin is regulated, the better it is, because the more it's regulated, it becomes more certain for institutional investors. And when it becomes more certain for institutional investors, they can price it, they can invest in it. If they can invest in it, there's only 21 million, then our view is, there is kind of only one way that this can go. So what are the approaches? You either ban it or you bring it into the system. And generally speaking, the trend over the last few years has been to bring it into the system. So Basel III now allows banks to hold Bitcoin. Bitcoin has the highest risk, is the highest risk-weighted asset, so it's very expensive for a bank to hold it. But the fact is, it's now an official asset class, and risk weightings can change over time as regulators understand the nature of the asset better. So it's now an official asset. I think the second thing that's very interesting is El Salvador has now accepted Bitcoin as legal currency. And as of tomorrow, I believe, you can now buy and sell things in El Salvador using Bitcoin. Now, what does that mean? Well, El Salvador is a proper country. Obviously, its monetary system isn't doing great. That's why they've moved on to Bitcoin. But banks in El Salvador now have to transact, secure, and value Bitcoin. And any foreign bank, any bank in El Salvador is connected to the international financial system. And if you can set up your systems, technology, operations, and processes in El Salvador, you can also do it for another country. And Argentina now is now potentially proposing, and a number of maybe 8 to 10 countries. So this suggests to us that Bitcoin really is becoming part of the system. Is it perfect? No, but it is now large enough and institutionalized enough that we think it will be. Now, if you did want to therefore invest because you see great opportunities, we must understand the landscape is a little bit different to a traditional asset class like equities or gold. So one are exchanges. Exchanges play a very important role in bringing together buyers and sellers. The challenge that we have is that there are more than 500 exchanges globally. What does that mean? That means your price can be different between the exchanges, anywhere between 0.5% to 10%. At one point, we used to have Korean exchanges at a 20% premium. We used to call it the kimchi premium. So that's a major issue. The other issue is liquidity. Can you get your cash in and out easily? So Binance, for example, now a few weeks ago introduced a $2,000 US withdrawal limit. I think the other challenge with exchanges is they're not all equal. They are mostly unregulated. And I think that's a challenge. Even in Singapore, where we have a very good regulatory regime, talk, for example, went down with 400 million. What are other issues? Derivative platforms. Well, CME is a regulated platform, that's great, but they're only one. There are multiple derivative platforms, and that means there are non-standard instrument prices and counterparty risk. There are also multiple coins. Every day you can create a coin. There are stable coins like USDT, USDC, and all of these are not completely transparent, and there are not clear regulatory frameworks. And then finally, every country has a different approach. So the regulations are different. That also drives why there are multiple parties, multiple exchanges. And it is difficult to move cash in and out. And today we still need cash to live. And so as an investor, if you can't get your cash out, that's kind of a major challenge. But it's actually this ecosystem that gives rise to unique opportunities. This is like the financial markets in the 80s and 90s. It's a great, unique opportunity for professional investors to make great returns. It's also a unique opportunity to lose money. So this is the environment that we're in. So how could you invest in Bitcoin? Well, you could do it through an exchange. And I guess one of the challenges we mentioned is that the price of that you transact in an exchange could differ between 0.5 to 8%. And that's a big hidden cost for an investor. Obviously, in terms of liquidity, I just mentioned, it's very difficult to get money in and out of the cryptocurrency ecosystem. Exchanges are increasingly under pressure to be regulated and comply with KYC and AML rules. So, for example, Binance has been in the news, unfortunately for Binance, where they have now stopped their service for Binance.com in Singapore. Binance.sg is still operating. So exchanges like Binance, some of them had introduced liquidity limits, $2,000 a day. If you do Sing dollars in Singapore with Binance, I think it's 20,000 a year, 5,000 transaction. The other issue is banks. Banks also are under pressure. And so if you get money transferred to your account from an exchange, there is always a risk that they will block it. And then, of course, there's security. So if you're online, you're always hacked. So what I do personally is I do this, which is cold storage, which is disconnected from the internet, put in a key, have a very, very complicated password. But for most people, that's challenging. If anything happens to me, there's a technical issue of how do people get it back online? But a more difficult issue is how do I prove how does my estate approve that it was mine first and it was theirs? And then there's some things around source of funds, source of wealth, to get around money, to comply with money laundering regulations that they would need to do for me, even though I passed away, and then prove it goes to them. So this is actually a big issue. And of course, we mentioned regulation and counterparty risk, for example, Talk that went under, and then the costs. So exchange is great, but what we say is for a professional investor, perhaps it's better to go for a regulated entity. So for example, Fintonia, we are a regulated entity, an institutional investor. So we've passed the KYC, AML due diligence of market makers, exchanges, banks, and so on. So we are able to get the best price for our coin and able to move large amounts of cash properly because we follow the right standards. So I think there's a difference, and it depends on where you are. The other way to get exposure to this fast-growing asset class is to potentially lend money. So this is like selling shovels to the gold rush rather than buying gold bars. And here, essentially, you can lend money to people in the ecosystem, and they give you Bitcoin as security. And it's like a margin call. When the price drops, they have to top up. And they can pay you high single digit to double digit, 10, 12, 14, 18% interest rates with attractive collateral levels, with over collateralization. And why is that? That's because the Bitcoin ecosystem I mentioned before is inefficient. So these players can make a lot of money trading derivatives, buying and selling on different exchanges, buying and selling different coins, and even investing and staking their coins in the new DeFi world. So if they can make a lot of money, they need cash to do that. And they will be willing to pay high interest rates and give security. So these are two ways where I think investors can get exposure to this asset class. So just to recap today, our view is Bitcoin is definitely a fast-growing emerging institutional asset class. Professional investor really should think about having part of their portfolio in Bitcoin. Bitcoin has very unique risks and opportunities, unlike other asset classes that you need to be aware of. And then we just shared a couple of ideas on how to get exposure to this asset class. So thanks for the opportunity to share. I will pass back to Carlos.
No, thanks for that, Adrian. That was super insightful, and I hope everybody on the call got some good takeaways on that. As I mentioned, we'll be circulating a recording as well of this discussion or this presentation on our blog page. So if you want to go back and review some of the slides in more detail, you can feel free to do so using the recording. But now let's move on to the panel discussion. So joining us this afternoon with Adrian, we have Joel Xiao, as I mentioned, who's a director at Morgan Lewis Stamford. So thanks for being with us, fellas. And yeah, let's dive right in. So let's first talk about the state of play in cryptocurrency investments. And let's start with Adrian. So, Bitcoin was first introduced, as a response to the 2008 global financial crisis. And if we recall, its launch caused, it came with a lot of negative sentiment at first, mainly by regulators and the large financial institutions. So why do you think financial institutions have had this change of heart? You mentioned some of the names like Morgan Stanley and Goldman's. They're now exploring Bitcoin as an investment option for not only their clients, but themselves. So what do you think really caused that change of heart?
Well, I think, there are a couple of factors, Carlos. I think one is just the sheer size of Bitcoin being around. But Stanley Druckheimer, who's a macro hedge fund manager, I think four years ago said that, hey, Bitcoin is a solution looking for a problem. And really, the problem has been found. And that problem has been inflation, as we see now, and the amount of US dollars that the Fed is printing. And that's really driven institutions to look at Bitcoin and say, well, actually, now it's of a certain scale, and now we actually understand the technology. Hey, this actually is a potentially good way for us to protect against the value of the dollar depreciating, right? And because it's only 21 million, because the technology has been robust over the last 12 years, I think institutions come in. And it's, in a way, a self-fulfilling prophecy. There can only really be one. And when you get bigger and bigger, it's like the VHS versus beta video standards. I don't know if people remember. Beta video tapes had better quality and better everything from a technical perspective, but VHS was more adopted. And that's what's happening with Bitcoin. There's only one. It's now big enough. The institutions are going in. It's getting better regulated. You're getting better services and infrastructure. So now, 12 months ago, you couldn't get many auditors to actually audit it. Now you can. Well, for example, if you wanted to do due diligence on somebody's wallet to make sure the wallet hasn't come from a terrorist or something like that, you can do it for Bitcoin, because Bitcoin is $990 billion market cap, 60 billion liquidity a day. So you're going to have a whole bunch of service providers that will do that. If you said, hey, can you do that for Dogecoin, which, you know, I need to do this to make sure the regulator is happy and the institutions are happy? No, it's too small. Right? Would you do it for this coin, that coin? No. So it has size benefits, and that's why the institutions come in. And in that way, it's kind of a self-fulfilling prophecy. The more and more institutions come in, the more liquid, the bigger it gets, the more services it gets, the more institutionalized it gets. So Bitcoin really is at that point now of that, we call it early mass adoption.
Yeah, no, thanks for that. No, interestingly enough, I was having a conversation the other day with one of the heads of Sotheby's in Southeast Asia, and she was saying actually for one of their upcoming auctions, they'll be accepting Bitcoin as a currency to buy some of the artworks. So it's definitely becoming more institutionalized, further than just the financial institutions.
Definitely.
So Joel, from a legal and regulatory perspective, how do you view the crypto investing environment today, and specifically in Bitcoin?
Look, a couple of ways to answer this, but how about anecdotally? If you go back 3, 4, 5 years ago, did I have anyone coming to me saying, hey, I'd like to set up a cryptocurrency, a Bitcoin fund? The answer is no. I think back then it was like, this is interesting, let's watch it, but there weren't any meaningful conversations. Fast forward maybe about 2 years after that, we started getting a couple of queries, particularly, you know, beginning of 2018, when there was a bit of a spike in price and all. But those quickly faded away. But now, if you go back maybe about 9 months to a year ago, these are coming in. There's a very serious interest in cryptocurrencies as a whole, certainly in Bitcoin. Right now, we're doing about 5 to 6 cryptocurrency funds in my practice. And notwithstanding whatever we see on the regulatory front, the fluctuations in pricing and all, clients of a long-term view, they're not reacting suddenly, you know, to sudden changes or actions by regulators, what have you. They're taking a longer-term view in relation to this particular asset class. I think to Adrian's point just now in the presentation, he referred to Bitcoin as potentially becoming an institutional asset class. I wouldn't use the same description, but I lean very strongly towards what Adrian's saying. We can see that it is indeed becoming the case. So I think we've come quite a long way. From a regulatory point of view, there was just very little to work with a couple of years ago. Like if I wanted to invest in this, so if I was involved in an exchange or payment services or what have you, you come to the lawyers and we just go, well, look, there's still catch up happening from a regulator point of view. But everyone now knows you got a Payment Services Act, for example, and that regulates how, you know, DPTs are exchanged, transfer from one person to another. That will continue to evolve, but I think that's directionally where we're going, and we'll continue to see more come into the space as a regulator seeks to understand better how cryptocurrencies operate, the technology that underlies it. We in Singapore have historically, you know, not in all aspects, we're not typically a first mover. We like to wait and see what's happening. We see what other regulators are doing, and then we kind of calibrate that for a local ecosystem, and then we implement. There are a couple of things. We're first mover. FinTech Festival, for example. I don't know any other regulator who's done anything close to that, but we've done something like that. But from a regulatory front, we tend to be a bit more cautious, and we want to understand a bit more. We can speak a bit more about it for the later questions as well, but I think generally that's the posture that MAS has taken. And we should expect that along the lines, MAS will, over the next couple of months and years, continue to refine the regulatory framework, whether it's for exchanges, etc., or whether it's for managers who are managing funds investing into cryptocurrencies.
Yeah, no, thanks. Joel, just staying on that topic, I know not everybody who's attending this call is from Singapore, but as you mentioned, Singapore is not often the leader with regards to regulation, but it's also kind of serves as a beacon for many of us here in Southeast Asia. So just to expand more on that, how has Singapore's regulatory requirements with regards to crypto evolved to keep up with investor interest while also kind of safeguarding investor capital? And how could you see that spreading throughout the region as well?
I guess the way to answer that question is to try to put ourselves in the shoes of the regulator. You've got a particular type of financial activity or asset class that is growing in significance. There's more and more market value that's invested into that. How are you, what are you thinking about as a regulator as you look to regulate this particular space? And, off the top of my head, I can think of a couple. You'd be concerned, first of all, with things like AML CFT. And that's been very, very topical, particularly for Binance, for example. That's the reason the FCA gave for saying you can't operate in the UK. But generally, if you read the MAS announcements, the press releases, incidents relating to, Adrian mentioned talk, for example, you'll see somewhere, in those announcements that MAS will make a comment now and then saying, be careful, this is a high risk type of investment and the AML CFT risk associated with it as well. So I think that's one thing. And that goes to the fact that you don't want to be seen to be a jurisdiction which facilitates anything that's criminal or layering or anything like that. You're compliant with the FATF requirements. The other thing you also be concerned about is, you'd be systemic risk. If it becomes big enough, right, does this pose a wider risk to the overall financial market? How are you going to control that? And investor protection, obviously that's important as well. That's a regulator's key job, to protect investors. And I mentioned just now reputational risk. So when we put all these together, MAS has to juggle a couple of balls, keep that in the air. And they're balancing that against, as you very rightly pointed out, Carlos, this whole thing about, we're trying to, as Singapore, try to show the way forward. We show that as a regulator, how we can be forward-looking, how we can think about developments, how we can engage it. So I think it's been pretty interesting. And I use just top of my minds right now, Binance is a good example. Now, this is my opinion, so nobody quote me on this. But if you look at Binance, right, Singapore and the announcements that happened last week, Thursday, Friday, Binance.com, Binance.sg, you know that Singapore was not the first of the pack, right? I think probably like about 7 to 8 regulators had preceded Singapore before we did anything. And even then, our message is quite calibrated. If you read the newspaper articles, fine. Binance.com has been told to stop operations. It doesn't hold a payment services license as it was supposed to. It's been put on the investor watch list. But in the same message, Binance, is it Asia Services, is in the process of applying for a payment services license that's currently under review. And they're seeing how they can decouple that from the wider Binance.com network. So it was a firm action taken by a regulator, but it was a very carefully calibrated message at the same time, that we're not taking a sledgehammer towards this whole thing. We're still looking at the payment services license that Binance.sg is applying for. And you find that overall, Singapore has been carefully calibrating the way it does this. Now, any of you in the audience who manage a fund that invests into cryptocurrencies will know that you can't get the Singapore tax exemption scheme to cover that. There's a list known as the SIDI list under the tax exemption schemes. And whilst it covers a whole list of typical traditional asset classes, cryptocurrency is not one of them. Now, this is not, in my view, direct regulation. This is soft regulation. You take it off the list, you don't get a tax incentive on it. You make the managers think twice. It's not quite the same as saying, I'm not giving you a license, but it affects your whole business model, your business proposition. You move it a level up, it's actually the license itself. Am I going to grant a license? Is this something that needs to be regulated or not? And how am I going to go about the market to enforce it? You take it a level down in between the tax and the license. What are the ongoing conduct requirements that you're going to impose on the licensees? So AML CFT is a very good example. Like, fine, I will give you fund manager a license to manage funds. And I know, for example, that you are going to be managing funds that invest in the cryptocurrency. Could they, via the AML notices and the guidelines, calibrate that slightly to deal with specific risks relating to crypto? Entirely possible. I think that's entirely possible. And that's a softer way without being so hard. And I think that, for me, kind of summarizes how Singapore has been looking at this, kind of cautiously encouraging, but at the same time, newsflash, be careful. This is still a risky asset class. Go about it carefully. I think that's how I sum it up.
Sure. Yeah. And just staying again with that, in terms of risk mitigation and how to be careful. Back to you, Adrian. You know, I know at Fintonia you're seeing kind of a different profile of investors. I think your investor base is more sophisticated and institutional by nature, but are interested in diversifying their portfolios by investing in Bitcoin. So how do you manage the risk of investing in Bitcoin while balancing out for potential returns?
So I think, I mean, for us, we have a number of different strategies, and we just shared two. One is what we call beta, which is, hey, just track the Bitcoin price by investing in a fund which just buys and holds Bitcoin. So Bitcoin is like the beta, and we manage security there. I think for an institutional investor or professional investor, you worry about two things, a number of things, but security. And I think we, in that case, the custodian that a professional institution like us uses is very important. In our case, we have a regulated, insured third-party custodian. So I think that's very important for any professional investor to know that, hey, this is managed by, or it's held securely by a third party. I think in South Africa, maybe 2 months ago, two brothers disappeared with US $3.5 billion worth of Bitcoin, right? So they self-custodized. So in Singapore, as a licensed entity, one of the things I need to do is to make sure I have a proper third-party custodian, right? So these are things that a regulated product must have that I guess we take for granted for equities or gold, but in crypto, in Bitcoin, it could be anything. So I think security is one that's a huge risk that a professional investor needs to get comfortable with. And the second one is cash in and cash out. How can I move large amounts of cash and buy Bitcoin and then sell it? And I think that's also where, for us, we mitigate that by making sure we have proper standards of KYC and AML. So, you know, by our nature, we only deal with sophisticated investors. And so we only deal with, you know, I mean, we deal with many, but compared to an exchange. So an exchange in Singapore, for example, could have 350,000 customers, and they will not be able to do the same level of detailed KYC, source of funds, source of wealth for all of them, right? But that's what they will need to do if they are able to move large amounts of money. So for people who want to invest, you know, larger amounts than 10, 20,000, for example, or 50, then really they're kind of stuck. And that's why we have our products. So I think that's, how we do the security for the beta product. So the beta is just buy and hold Bitcoin. That's beta in crypto, and beta in crypto can be up 10 times, unlike gold. The other product that we have is if you want less volatility, it's that lending product. And that one has more of a fixed interest type of return, but has quite good security features in that you hold a lot of Bitcoin, right? And then if Bitcoin was to drop, you can, because it's liquid, you can sell it and make sure that the loan is never really take a loss. So I think that product as well is the other way where we try and, depending on the investor appetite, give exposure to the asset class but also some security against a loss. So they're the two kinds of products that we have for different types of investors, but both products are really only for the professional or sophisticated investor.
Got it. And I do want to save some time at the end for some questions from the audience. So maybe I can close out this panel by asking you both to kind of bring out your crystal balls and get your view on what the space is going to look like moving forward. So Adrian, let's start with you. How do you see the crypto space continue to evolve moving forward?
I think Bitcoin is always going to be the big mama. It's going to be the original, and it will be the beta. And so all of the new things that we see now in crypto, which is in decentralized finance, a lot of the coins, NFTs, oftentimes it's still driven by beta. The Bitcoin will be the beta in the market. And oftentimes when people want liquidity, if you wanted to change that coin or that NFT, eventually it moves into either Ether or Bitcoin and then cash. So I think Bitcoin's role in the ecosystem will always be there. But actually my view is that Bitcoin is kind of like the old mother. It's really the bedrock of the crypto ecosystem. But there's some really exciting things happening around NFTs, around the metaverse, some exciting things happening around alternative coins. But, they're probably more suited to, at least from a professional investor perspective, more of a closed-end VC type fund, right? Because these instruments are very difficult to mark the market every day, right? They don't have the same liquidity and so on. So I think we'll always have Bitcoin as a liquid beta product, but I think the crypto markets are just moving so fast that there's going to be a lot of things built on that foundation. So I'm very excited.
Great. And same question to you, Joel, just from a regulatory perspective.
Look, I think it's a very exciting space to be in. I alluded to just now that typically regulators are playing catch up. They're waiting to see what's happening in the market, and then they react accordingly. What's reasonably clear to me is that I think it's, as Adrian's saying, I think cryptocurrency, certainly Bitcoin, they're all here to stay. And from a regulatory, from a lawyer, from the type of work we do day-to-day perspective, let's put it this way. 2 years ago, clients are coming to me and they're running a hedge fund or they're running a venture fund, and they say, hey, can you take a look at my fund docs? Can I put a little bit, 5% to the Bitcoin, because there's so much happening over there. Now we're seeing proper funds where it's 100% dedicated to cryptocurrency or Bitcoin or Ether. We'll continue to see that, and that's on the direct investments into the crypto assets. But I think over time we're seeing that now as well, where other parts of the entire process or the entire ecosystem become attractive investment propositions. For example, investing into companies that build the technology that supports cryptocurrency or different DLTs and what have you. And that's more venture, but then very clearly with a crypto slant to it as well. Mining, for example, there's some of our clients as well are investing into companies that buy machines that only do mining. And that in itself, I see, it's crypto, yes, the asset class, Bitcoin, the main cryptocurrency within that, but there'll be this spillover effect that you see spread right across the different types of what we call the open-ended and closed-end fund asset classes within the space. I see that happening. I expect, I'm keeping my fingers crossed, but I referred just now to the SIDI list for cryptocurrencies. I think at some point, MAS and RAS will recognize it. Now, whether they're going to give a blanket recognition to all crypto or maybe specifically to Bitcoin, I don't know. But fingers crossed, I am holding my breath for that. And I think that will happen. And to me, that's a very, very important indicator. When that gets the green light, I think that to me is MAS's soft signaling to the industry that they've gotten comfortable and very comfortable with it, that they're willing to grant you, a tax exemption on that. But yes, overall, that's a general direction. Will regulations become more heavy over time? I don't necessarily think so. As I said just now, I think MAS adopts a calibrated approach to how they regulate the industry. They will tweak. I think they'll tweak certain things here and there, but I don't expect, another payment, a new act, not a payment services act, but another one coming. I don't think that'll happen. I think they'll work within what we see right now, the construct of what's existing, but they'll fine tune that to adopt to the changes.
Awesome. Okay, so let's move into some questions from the floor. The first one here, maybe I'll pose to Adrian. So the person is asking, the spread from exchanges and the pricing in different countries varies. It can go up to 20%, as you mentioned. How can individual or casual investors ensure that they are entering at the best possible price, if possible at all?
Yeah, that's a good question. And I think, sadly, there's no easy answer. I guess one answer is you then have to open an account with multiple exchanges and then try and get the best price. Once you open an account with multiple exchanges, there is software that tries to help you do that. But for the casual investor, this is very, very difficult, problematic. And obviously, when you open an account with many exchanges, you actually need to put cash in all of the exchanges if you want to trade, right? So for most investors, that's difficult. I guess that's why for an institutional investor like ourselves, that's easier because we do this full time. So we can open up multiple accounts with multiple exchanges. And we also deal with a market maker. But I guess that question also goes to show why for our second product, we are able to lend people money and get a high interest rate and get Bitcoin as security, is because people who are trading and trying to arbitrage, they need to open accounts with 10, 20, 30 exchanges and derivative platforms. And then they need cash to be able to trade and make the arbitrage. And it's exactly this inefficiency which is difficult for the, I guess, casual investor. But if you're a casual investor and you put a small amount of money, then yes, that spread of 10% or whatever, maybe it doesn't matter over a period of 12, 24, 36 months, right? But I don't think there's an easy answer because I think the answer is you really can't unless you want to connect with all the exchanges, or you can go to a market maker. The market makers don't connect to, I guess, casual investor.
And just sticking with you, Adrian, we have another question. So you mentioned, El Salvador briefly in your presentation, and how they made the decision to make Bitcoin legal tender in the country. What weight will successful implementation or failure of this policy have on the global Bitcoin market, in your view?
Oh, it's hard to say, but I think generally, I think it's a positive thing that it's going to be used. There will be for sure implementation and teething problems. But the fact is, I think, as I mentioned, if El Salvador can use it and Basel III say you can hold it as a bank, as an asset, then really it's becoming institutionalized. So the general trend is, be positive for it to be that way. But if you wanted to ask, hey, what does it mean today or tomorrow? And for example, the price is now going up. People say that's because El Salvador is going live. It's hard to tell what's it going to mean in the next day or week or month. I just say it's, sometimes it's better to be like my mother. At the start of the year, it was 8,000 Bitcoin. We went to 60, but she wasn't looking at it. And we all thought we were heroes. Then it dropped to 25. Then we all thought we were going to jump off a cliff. And now it's back to 50. And then when I spoke to my mom the other week, she goes, "Oh, how's Bitcoin going?" I said, "Oh, it's at, it just broke 50." And she's like, "Oh, that's great. It always goes up." So sometimes it's better just not to look at the price. But I think if you take a longer term view, El Salvador taking it in will be positive for Bitcoin.
Okay, here's one for you, Joel. So can individuals, both foreigners and PRs and citizens holders, so I'm guessing this is coming from a Singaporean, have institutional custodians like Fidelity hold Bitcoins with legal insurance covering the value of the asset in fiat in a jurisdiction like Singapore for payout in case Bitcoins are lost from custody. So either from being stolen or hacked.
Okay. Interesting question. I think first up, it is simply a case of is there such a product? Can you find an insurance service provider who's willing to do that? So, by all means, take a look. The answer is I don't know whether there's such a thing. Haven't looked into this before. But I think the other relevant aspect is that depending on how you have access to the Bitcoin and to the cryptocurrency, for example, I think Adrian very helpfully summarized it in his presentation just now. You can either go direct, open your own accounts and with the exchanges and your own wallets, or you go in via a fund. Now, I come from the asset management, from the fund space, and I think it's worth mentioning, especially when we talk about custodians and all, is that if anyone goes into a fund that's managed by a regulated manager in Singapore, that manager has an obligation to ensure that the assets are custodized. And I think that in itself provides to a large degree a measure of protection. And obviously, if there's any issues like theft, hacking into the exchange where the cryptocurrency is held, you're one step removed. It will become, the likes of people, Adrian, who will have to sort it out and try and figure out how best to recover the value. They'll think about the insurance solutions. So I think that's how I respond to that question.
Maybe I can jump in there then, Carlos. I mean, so Fintonia, we do use regulated custodians, and those custodians have insurance against theft and hacking. Getting insurance against theft and hacking as an individual, I would say, is next to impossible. I mean, we're now talking to people out in Lloyd's and Bermuda, and it's a very specialized thing. So it's very unlikely an individual will be able to get that. And I guess the other, response to that question is, I think it's also very difficult for an individual to get the attention of an institutional custodian like Fidelity, or we use BitGo, or whether that's Anchorage, or whether that's Kingdom Trust, or there are a number of different regulated custodians. It's kind of hard to get their attention if you're an individual, unless you happen to have you're Satoshi or something, and you have all of the Bitcoin. So I think that's also unfortunately the challenge for an individual investor, is it's difficult to really create an institutional grade secure product yourself.
Yeah, thanks for expanding on that, Adrian. A couple of more questions for you, Joel. So are crypto derivatives regulated in Singapore? And if so, which regulation covers that? And then to follow, is it safe to trade on exchanges which are not on MAS's approved list? I know you can't give a official recommendation, but maybe you can highlight the differences between an approved exchange and a non-approved exchange.
Okay, so maybe I'll deal with the second question first. So, is it safe to trade on exchanges which are not on MAS's approved list? This is not a legal response. I would say that you have to go and do a bit of due diligence to understand who regulates them. If they're not MAS's approved list, are you accessing them on the internet because they're based in another country? Who's the regulator there that deals with them? And if they're not regulated, then just be aware that, in the event that anything goes wrong, there'll be next to no protection for you. If the assets are hacked, or if in fact it turns out to be a massive fraud, fine. I think there will be criminal charges and what have you brought against the individuals, but you would largely, I should say, in those cases, be quite unprotected. So no, it depends, but if it's the extreme case, it's not. Of course, it's not safe. Look, if you have instances where tokens are offered under the SFA, it's more likely than not that you're dealing with a regulated entity in Singapore. So I think that hypothetical that is offered in Singapore, but it's not regulated, I think that's quite slim. There'll be somehow in the entire process, somewhere along the way, and if you're the individual, there would be a regulated entity involved. It's a bit too complex to break down that whole regulatory analysis, but suffice to say that there should be. If you're an institutional investor in Singapore, different story, but I'm assuming we're talking about individuals right now. So I think that's on on the second question. Are crypto derivatives regulated in Singapore? And if so, which regulation covers that? It's just an interesting question. I'm thinking my feet a little bit on that one. I think it's quite likely that crypto derivatives will be classified as securities under the Securities and Futures Act, and accordingly be regulated there. So depending on the type of activity that's taking place in relation to it, if you're dealing with an exchange, then are you going to be would the exchange itself need to hold a license under the SFA to be an approved exchange? If on the other hand you're dealing with a manager who's managing a fund that's investing into crypto derivatives, then look, the manager can invest in it anyway, but it begs the bigger question of things like tax treatment. There are also the knock-on things I mentioned just now, like AML, CFT. There are certain considerations as it relates to the offer of the fund itself. It's most likely to be treated as a conventional, typical fund offering because of the assuming that the analysis for the crypto derivative is that of a security. So yeah, like off the cuff, I think that's my initial response to that question.
Great, and we've got a couple more here. I know we're close on time, so maybe let's end with these last two. Joel, can you just expand a little bit on how crypto taxation works here in Singapore?
Okay, I'm going into territory I'm not too qualified to speak on, but nonetheless, let me give you at least an anecdotal kind of response. So just to be clear, we help clients set up the funds. We always work with a tax advisor to provide a specialist tax advice. But nonetheless, my understanding is as such. Now, if you're running a fund in Singapore, you can, for each one of the fund entities that you're managing, go to the MAS and apply for a tax exemption scheme. Now, if you qualify under that scheme, and if all of your investments and the return that you're making on it falls within the permissible categories, I referred to the SIDI list just now, specified income designated investments, then yes, you'll be able to get that tax treatment effectively of 0% on whatever income arises from that. So the tax treatment question when you're dealing with cryptocurrencies and all is that when you set up the fund and you apply for the scheme, you want at the very initial stage of your process to be speaking to your advisors as to whether exactly that particular asset falls within a permissible category. If it doesn't, there are some structuring options that some advisors are offering in the markets. I'll leave it to them to expand further without venturing into territory I'm not too familiar with, but there's some that are being explored. I think it's a case of risk appetite as well as just simply sensible characterization of the features of that particular asset. A lot of it comes down to that. Yeah.
Okay, great. And one last cheeky question for you, Adrian. Any price targets for Bitcoin by the end of the year? And maybe if you don't want to give a value, maybe you can talk about some events that you see that could happen by the end of within this year that could drive the price either up or down.
Yeah. Well, I certainly don't have a price target because one thing I know is in the years of Bitcoin is that it's been volatile. Even the volatility has come down. I think it's around 70% annualized now, or 60 odd. So Bitcoin has got more liquid and less volatile since it started, and that continues. There are a number of analysts that are, I wouldn't say predicting, but are suggesting that it could well hit over 100,000. And the reason why it's difficult is this. If we value gold essentially through charting, a combination of the incremental cost to mine gold, and then basically people use technical charts, right? Because there's a long history of inflation, monetary policy, and correlation to gold, right? Because people see gold as a store of value. So store of value is basically perception. It's what you think it will be. And there's a history of that. And so people can use charts and history. If Bitcoin is going to be similar, then there is no discounted cash flow forecast for Bitcoin, just like there isn't for gold, right? And therefore we have to end up using charts, and the chart correlation over the years is still being developed, I guess. But one thing I would say, my own view is, if you take a 3-year view, is Bitcoin going to be significantly up? I believe so, if the level of institutional interest continues on. Just mathematics. Institutional interest, 21 million fixed. There's just demand and supply. So if I took a 3-year view, I'll be saying for sure it's going to be way higher, multiples higher than we are today. But I will leave you with a bunch of analysts who are predicting 100,000 by the end of the year. But, you know, Noel Rubini thinks it's going to be worth 0, right? But even he's now changing his mind. So let's see.
All right. Thanks for that very PC answer. No, so I think that's all we have time for today. Thanks so much to Adrian and Joel for joining us and sharing your super valuable insights. I'm sure our audience had a lot of great takeaways to bring away from the presentation and the panel discussion. So thank you again for taking the time to be with us. And thank you to the audience for providing good questions that kept the conversation going. You know, as I mentioned earlier, a copy of this recording will be up on our blog page soon. We'll be reaching out with each of you that registered to share that within the next day or so. If you'd like to keep up to date with what Fundnel is up to, do follow us on LinkedIn at Fundnel. We'd love to keep in touch and hopefully meet you in person very soon. And with that, thanks again, and we hope to see you again at our next webinar or event. Thanks, everybody.
Thanks, everyone.
Thank you. Thank you all.
Thanks, Carlos. Thanks, Joel.
Thanks, Adrian.